warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Welcome to another episode of the Open Treasury podcast, Paul and Ben.
Thanks, Push.
Yeah, thanks for having us, Push.
A big thank you to you both for taking the time to share your thoughts with us on topics that impact the world of corporate treasury management and beyond. In today's edition, we shall discuss 4 topics, namely PwC calls for shift from supply chain resilience to growth, Japan's US corporate bond sell-off could bring volatility, JP Morgan launches programmable payments, and IMF says central bank digital currencies can replace cash. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's commence today's discussion with the first story, which is about PwC calling for a shift from supply chain resilience to growth. A new report from PwC titled Global Supply Chains, The Race to Rebalance outlines the considerations business leaders need to contemplate to survive in a rapidly evolving business environment, one of which includes supply chain disruption. There's a global race happening right now as businesses look to rebalance their supply chains and seek new suppliers, locations, and talent. It's no longer enough to focus on resilience and short-term profitability. Businesses need to transform for viability. Ben, you covered the story for CTMfile. So for a change, if I may start today's podcast by addressing my first query to you. The PwC report considers the challenges facing organizations seeking to relocate supply chains given geopolitical uncertainty. Companies seeking to rebalance operations more evenly across different geographic regions are unlikely to find a single location that can replace China, as per the report. In such an environment, what do you think are the key points that corporations and their treasury departments need to consider when repositioning their supply chains for growth?
Yeah, that's a great question, Push. And it's definitely something that is reflected in the data from this survey from PwC. One stat that stood out to me from the survey was kind of showing how Asia-Pacific companies are slightly ahead of the curve on this. 43% of Asia-Pacific CEOs are investing in supply chain transformation versus 41% globally. So not too much of a difference there, but notably this figure is above 50% in China and also in Malaysia as well. And it's clear that you do need investment if you want to change your supply chain, specifically kind of hand in hand with the digitization of supply chain management that we're seeing. And there were kind of practical steps that businesses can take to sort of rebalance for growth that was noted in the survey. One of which, I mean, some of which might be self-evident, but it's worth just kind of taking a look at them. First of which was to kind of elevate supply chain importance within the business to the C-suite, if not the CEO itself, making the point that the supply chain isn't just an operational concern. You know, it's so much more than that. It's kind of a strategic asset that's key to success, particularly in the sort of turbulent times that we're having at the moment. Companies could also differentiate their value proposition as a way to perhaps win over possible new suppliers, sites, and talent pools. You know, competition for sites and suppliers is intensifying as so many more businesses are looking to rebuild their supply chain or reposition their supply chain. You know, there's not an endless resource that everyone can just go and do this however they want to. You've got to look at what's available and what's possible. And a lot of the time that will take investment, but also differentiating the value proposition to kind of position better for success Another point is around sort of government incentives have long been something that's had a bit of a sway on how some companies look to position their supply chains, which countries they might want to be in. If they're getting, a nice tax write-off in a certain jurisdiction, that might give that place the edge. But the point that comes through this report is that kind of looking beyond those types of one-off incentives or kind of cheap ploys to attract a company to a country, and rather instead looked the suppliers and the talent and identifying where the future growth of the company will be. So just kind of looking beyond the easy win and really getting stuck into the due diligence in terms of, is there an available talent pool and suppliers nearby? Is that ecosystem that your business needs actually present in the country that you're looking at? And if it is that where your future growth is going to be? So there's a lot of research and investigation that I think needs to be done. This is quite a long-term, thoughtful project that needs to involve obviously treasurers, but every stakeholder that touches the supply chain in a business. And just leaping back to that previous point, the C-suite as well, at least the CFO and possibly the CEO as well, because obviously it's the whole future of the business that you're thinking about when you're considering how to rebuild your supply chain. And particularly, as the title of the report says, not just for resilience, but for growth as well. I think sometimes you can forget when things are so tumultuous, and they have been for at least since COVID, so that's 3-4 years. You can always get into like a war mentality in the bunker of the finance operation within your company. So, what else can be done? How can you actually kind of get the advantages and actually use it as a tool for growth for your business, a kind of a reciprocative arrangement with how you're looking at your supply chain? So those were a couple of the points that kind of came out of the report.
Yeah, Ben, I think those are all good points. I think about supply chains. We've had various conversations over the last 12 plus months just on supply chains, a variety of things. Organizations looking at their footprint, trying to decide, should they change things? How do they change things? How do they finance? How do they ensure that the demands on their own business are going to be met by the existing supply chain? We've had a lot of existing setup that's been there for quite some time. So, it's maybe in some respects, this report is really saying, hey, supply chains, you've been stagnant for a long time, and it's time that you wake up and you start doing things differently. And they have been thinking about things differently. And there are things that are, new technologies that are being deployed, they've been tested, they've been deployed. Some things were successful, some things were not. We learn from that, and come back at it again. But what's really interesting about this idea of, supply chain for growth is it's multi-factor. I've talked about, companies are going to diversify their supply chains because they realize what came out of COVID and other geopolitical things that have been occurring is that if you have all your eggs in one basket, a disruption can be extremely painful. And a lot of organizations globally felt a lot of pain when we had the massive disruption of shutdowns. That was significant. And it started making things, people rethink how they do things. And so, will there be a lot pulled out of Asia? No, I think what we'll see is there'll be some pull out of Asia, but not entirely. We will also see opportunity for other APAC countries to jump into supply side of things. So distribution may morph into something just a little bit different in terms of footprint within Asia, but it's also changing within, various countries where they're bringing, whether it's friendshoring, nearshoring, onshoring, part of the diversification process. As you do that, this concept or the idea of setup for growth is really important because now you don't have to do things necessarily the way you did it before. Does talent matter? Yeah, absolutely does. How you set things up matter. The technology that you utilize matters. Your third-party partners matter. So it becomes, really important that you have the eye on growth, that you have the eye on the total footprint, the portfolio of your suppliers, and how you're going to manage that. So I think there'll be a lot of good things that will come out of this. And I think organizations will be better off and better positioned for things that could be disruptors out there. It could be that it's a microcosm within a region, or it could be more global. Having the ability to be prepared for that is what's going to come through this process.
And yeah, I completely agree, Paul. And investing in technology, which is something we both touched upon, kind of one way that can be used is to digitize a company's sort of whole supply chain ecosystem to really kind of get full visibility into the supply chain, because that's so important from a risk management perspective, in terms of being able to see not just your suppliers, but who's supplying your suppliers and where might potential risks be further out in the supply chain. And that can also help, I think, strengthen relationships and, the knock-on effect of improving revenue there. Another point as well that I think a lot of forward-thinking companies are looking at is like their customers, their investors, business partners, tax authorities, policymakers. There's a lot of different parties continuing to press for change on ESG matters, which means that corporates have to respond to that. They have to find ways to make sure that they're not kind of having any negative impacts across the ESG spectrum through their supply chain, because that reflects back on the corporate at the top of that supply chain and probably isn't going to be very helpful for longer term success if you're trying to position yourself for growth. And also proactively partnering with suppliers can help boost innovation and reduce risk through perhaps strategic diversification, and enable some of that inclusive growth. And particularly, again, collaboration on ESG matters can help to improve the quality of an organization's reporting on sustainability, but also help drive change throughout the ecosystem, kind of scattered down from the corporate at the top of the chain through their suppliers. So yeah, there's a lot to think of, and a lot that corporates can be doing to sort of reposition themselves here.
Ben and Paul, you've highlighted some great points with your informative analysis. Let's now shift the conversation to our second story for today, which is about Japan's US corporate bond sell-off that could bring volatility. Credit managers are awaiting the release of data that will show whether Japanese investors' aversion to US corporate bonds in August was a blip or marked the beginning of a trend. Government bond yields in Japan have risen in recent months as speculation grows that the nation's central bank will step back from its ultra-relaxed monetary policy, which could persuade investors there to move money to take advantage of higher returns. Japanese investors have traditionally been among the biggest buyers of US corporates, so any such move could reduce global market liquidity and increase the risk of volatility. You have experience in that area. You've traveled, you've worked there. The demand for US company debt from Asian investors, including in Japan, has already noticeably softened in recent months, according to reports based on feedback from bankers. From a corporate treasury perspective, does it concern you that reduced demand from the deep-pocketed investors for US blue-chip debt would likely translate to higher borrowing expenses for US corporations, which are already facing some of the highest financing costs since the financial crisis?
Yeah, Push. I mean, the reality is that higher costs are here. Could they be pushed up more due to some of the points you just made? Yeah, absolutely could. You think about Japan and their position around, why they're pulling back on U.S. corporates. It probably makes some sense from their standpoint. They turned around and they've bought a bunch of treasuries. So it's kind of a move from one to another. There's a repositioning for them, and Japan, it's been a long time that they spent with extremely low interest rates, low prospects of actual growth or the ability to get yield within the country. So they've been deep into U.S. corporates for a long time. With a shift from the BOJ to something that would be more, as they call it, ultra relaxed monetary policy, that absolutely will, definitely have an impact on their appetite. But the other thing is that just globally, people have been positioning themselves for, a downturn in the U.S. And so some people, have been pulling out money for some time now out of the U.S. As an investment in terms of corporate debt. So I think that's just a natural economic flow of what we're seeing out there. Does that mean that they're going to be completely out of it? No, I think it's diversification. It's a movement to, perhaps, instead of being in a position of having more than target, they're going to be less than target. I don't think they completely abandon the U.S., but when you think about volatility that's been occurring out there, we've seen foreign exchange rates have been quite volatile. They've come down somewhat in recent months. Hedge ratios have gone up. So people are out there trying to take risk off the table because risk has gotten higher. So I think hedging will continue to be in play. Although this article talks about, the acceptance of the volatility, and some companies will continue to accept volatility of what's going on in the markets and hedge where they perceive the greatest risk is. I think taking a position to hedge away all risk, given costs, is not the best approach. I think it's hedging away the right risk. So it's a matter of perception of how Japan as a whole views the monetary policy of the BOJ. The bigger question is are they actually going to take that step forward or not? So right now we have speculation. And as you well know, out in the markets, you have hedgers, you have speculators. So you get people on both ends. Somebody's going to be right because this is a zero-sum game. If it's not zero-sum, that means there's arbitrage out there. So I imagine we're going to see some arbitragers that are going to profit from what's going on out there right now. So this is definitely an interesting dynamic. And if I'm thinking about, I'm a portfolio manager and I've got positions, I might want to take a look at that and see where the right opportunity is. Who knows? That may pay off.
Yeah, that's very valuable analysis, Paul. I think I was going to hop from this story into kind of the wider US deficit issue, because there was an interesting report I saw at the end of last week coming out of Citi that noted that rising US government debt and fiscal deficits that have helped lift government bond yields this year will likely become secondary factors for investors as their focus shifts further to economic fundamentals. Concerns over increased government bond supply and larger fiscal deficits contributed to a surge in government bond yields, which move inversely to prices, of course, to 16-year highs this year, while pushing rating agencies such as Fitch and Moody's to turn negative on US government creditworthiness. And even though those challenges are unlikely to recede, investors will eventually grow accustomed to the risks, partly because of the lack of alternatives, given the US dollar's status as the global reserve currency, to the depth and liquidity of the US government bond market. So that was really interesting, a report that Citi's global chief economist, Nathan Sheets, had at the end of last week. So that was kind of my, if not totally in line with the story, just kind of supplemental look at what's going on.
I think about the current amount of debt the U.S. has taken on, the stinging bite of increase in interest rates. We sat in a period of zero to low interest rates for a long period of time. You can see how much more debt we put on the books during that period. It was significant. And now it's come back to bite the U.S. in terms of interest costs and continuing to service that debt load. The U.S., and this is just Paul's opinion here, the U.S. really needs to step back and take a hard look at that and stop kicking the can down the road. And we've had a habit of doing that. We're not focusing on the longer term. We're too focused on the near term. because that's where the pain is right now. But it could be much worse down the road if we don't start thinking about the long term and what those impacts are.
Well, Paul and Ben, you certainly brought up some fascinating insights, and I couldn't agree more. Moving forward to the third story in today's discussion, which is about JP Morgan launching programmable payments. Onyx by JP Morgan has launched programmable payments as a feature for blockchain-based accounts on the JPM coin system. This will allow users to program payments for the first time using an intuitive interface. Siemens AG executed its first payment using the programmable payments functionality on 6th of November. FedEx and Cargill plan to go live in the coming weeks. Ben, you wrote this story for CTMfile. Can you please throw more light on programmable payments, and how do you think these type of payments will impact corporate treasury?
Yeah, absolutely. So programmable payments facilitate an automated process that can respond to real-time events, basically. So they follow pre-programmed rules. Payments are initiated anytime that the conditions are met, which kind of removes the need for human intervention to discover, calculate, and confirm the required conditions needed before a payment can be executed. So there's certainly a great potential for time saving here. And the result can be quite transformative, allowing much faster transactions and resolving a common liquidity problem for businesses, which is needing to assign excess liquidity buffers during periods of Treasury team downtime. So, weekends, bank holidays, overnight, all of that can be addressed through programmable payments. So this offering could have a huge significance for corporate treasurers. Rather than relying on next day processing and things like manual monitoring and forecasting models, payments are instead initiated based on accurate live events. So basically with programmable payments, you're seeing a move for Treasury basically from a static entity to a more responsive, real-time, dynamic entity, allowing those business capabilities to be embedded into business processes and sort of turning on its head the traditional financial services model. And also, I think it's worth noting, you said, obviously Siemens made the first transaction with this. They'd been working with JP Morgan since, I believe, 2021 on this. So there was a lot of involvement that they had as a corporate to make sure that this development went in the right direction and was going to do what they wanted.
This is really interesting to me, and something that I think is definitely kind of a game changer in terms of payments. So now you've just literally introduced payments with optionality, that you hit a trigger, something happens. So as an event happens, and then that forces the payment to happen. What makes this really unique for treasurers is it's an automated play for managing liquidity. So that means you've got to have the right levers in place so that you have the liquidity when you need it, especially around the movement or the shift to more real-time payments. There's going to be a greater demand for visibility, transparency, for management of your liquidity levers. And I see this as one of those pieces of the puzzle that can help manage that more effectively. Being able to say, these events occur, here's what you do. Yeah, you don't have to have a person on the treasury team that actually makes that decision. The program makes the decision for you. So it's something though that one thing to consider, programming payments, just like with anything, environments change. You may have to change the way the payment's programmed. So you have to have the ability to change that due to things that are happening either globally, macroeconomic within the region you're in, or within your own country, or microeconomic items. You gotta have the ability to have some flexibility with that as well. But, optionality on payments, I think that's pretty cool.
And I think particularly for companies that have business models like pay-per-use or subscription models, these tend to require a high degree of automation, as they tend to bring in a significantly higher number of payments with much lower amounts at the same time, particularly when it comes to something like micropayments. So I think that's one use case where programmable payments will be particularly appropriate.
Well, Ben and Paul, we appreciate you bringing clarity and understanding on the topic of programmable payments for our listeners. From programmable payments, let's turn our attention to central bank digital currencies, or CBDCs. CBDCs, or central bank digital currencies, have the potential to replace cash, but adoption could take time, says Kristalina Georgieva, Managing Director of the International Monetary Fund, or IMF. CBDCs can replace cash, which is costly to distribute in island economies, she told delegates at the Singapore FinTech Festival. They can offer resilience in more advanced economies. CBDCs would offer a safe and low-cost alternative to cash. They would also offer a bridge to go between private monies and a yardstick to measure their value, just like cash today, which we can withdraw from our banks. While the IMF reports that more than 100 countries, around 6 in every 10, are exploring CBDCs, and the level of global interest in CBDCs is unprecedented, with several central banks already launching pilots or even issued a CBDC, it stated in a September report. However, as of June 2023, only 11 countries have adopted CBDCs, with an additional 53 in advanced planning stages and 46 researching the topic, according to data from Atlantic Council. Over the past 2 years, CBDC has found its way into the lexicon of central banks, governments, finance chiefs, and corporate treasurers. However, do you think it is time that corporate treasurers should start taking the world of CBDCs more seriously by understanding the potential implications for Treasury? For example, CBDCs and their impact on daily cash flow and liquidity, CBDCs and cross-border payments usage, or for that matter, the risks and regulations that would apply to CBDCs.
Yeah, Push, I think banks writ large are going to have to get this on their radar screen if it's not already, because it's coming. It's not a matter of if, it's just a matter of when. But we know that adoption rates in Asia tend to be much higher than what we're seeing in Europe and the US regions. Adoption rate's one thing. The other thing is the ability to be positioned so that you can handle these currencies once they're available in the market. And I don't hardly carry cash around in my pocket just as a consumer. I typically use a card of some kind to make payments. So, what's the difference to me using a CBDC or using a credit card or a debit card? To me, they're synonymous. We're engaging in a transaction. We're sharing a mode of value. So whether it's digital or whether it's paper or coin, I'm indifferent. It's still a mode of value for exchange of goods and services. So CBDCs are coming. Yeah, it will be something that, at some point, it'll be everywhere. It's just a matter of time. I think banks and companies and treasurers, they have to start thinking about, okay, how are we going to deal with this? How are we going to handle this? How does this impact us? Organizations, if they're not prepared for it, they're going to be in a situation where somebody wants to utilize that as value for payment, and they may not be positioned to handle it the way that they really want to handle it. So I think we got to take steps now to be prepared for the future. If you look at the survey of the central banks they surveyed, 93% say they were exploring. Okay, that's quite a few. If 93% are exploring, then organizations out there should be preparing for the idea that, hey, this is probably going to come. I know some of them are going to, you're going to have the variety of adopters. You're going to have some that are going to adopt quite quickly. And you're going to have some that are going to sit on the sidelines to see what happens with the ones that adopt quickly. Then you're going to have the folks that, they're going to wait until it's been tested and tried and all the kinks have been worked out, and then we'll jump in.
Yeah, those are great points, Paul. And I think the report, obviously talking about CBDCs replacing cash, I do think there's a difference to be just kind of underlined between wholesale and retail CBDCs. Wholesale CBDCs will be for financial institutions to facilitate the settlement of large value interbank transactions, which is fine. But I think the bigger obstacle to overcome is on the retail CBDC side, which, your man on the street, your woman on the street, the general public might not be overly enamored with the prospect of a government being able to see when or where they're spending their money and what they're spending it on. I'm not sure that would be overly popular. In fact, there was research from the Cato Institute earlier this year that found more than twice as many Americans oppose a CBDC issued by the Fed than support it, for example. But that same report also found that only 28% of Americans know what a CBDC is. So there's clearly a big educational point to address in more than one sense on that point. I think a couple of things are quite clear. And as Paul said, one of them is that CBDCs are coming, but they're not for some time going to replace cash. They'll probably be an alternative form of currency in parallel with traditional fiat currency, and corporates will be monitoring adoption levels of CBDCs in all of the markets that they operate in, because it's potentially yet another payment channel that the companies, particularly in the retail space, may have to contend with, rather than a single channel for all payments that are coming into them, even though that may be 20, 30 years perhaps down the line, the overall end game with this. So it's figuring out what, your systems might need to be capable of, whether you want to even offer this as an option of payment, depending on adoption levels. So yeah, it's still early days, I'd say. But it's fascinating to just have the concept of digital currencies replacing cash.
Yeah, good points on the retail side. Some people are not, they're not going to care that you can tell I went to the grocery store and I buy groceries. What they're maybe more concerned about is, what do I do with my personal time for entertainment or otherwise? And that's where I think you'll see people will still utilize paper currencies and coins to pay for things so that they're not being tracked. And there is this sense or fear that Big Brother's watching me, and CBDCs offer the opportunity for Big Brother to see everything I'm doing. So I think there'll be this combination on the retail side for sure, Ben, the way you point that out. People will use CBDCs for certain things and not for others. So it'll be interesting to see how it all plays out. It's just organizations that are just going to have to be ready and positioned to deal with it, because it's just going to happen at some point. And when it happens, if you're not prepared for it, it may be a little problematic to accept, own, and manage something for a transfer or service or good. So you just got to be prepared.
Yeah, what you just said there, Paul, reminded me, today you might deal with a tradesperson that says, oh no, I need cash. I won't take payment by card, for specific reasons. So that sort of issue might well carry on in a different form further down the road.
Yeah, no doubt. I mean, there's still, here in Des Moines, Iowa, Central Iowa, period, there's plenty of places that I go to where they're cash only. They don't do it any other way, and that's the way it is. And some organizations are going to continue to be that way.
Absolutely. So what both of you mentioned is extremely important. It's coming. We need to be prepared and also understand the implication of retail CBDCs versus wholesale CBDCs, important aspects like privacy, security, interoperability, regulations. But one thing I think all of us would agree upon is that it is coming, and we need to attune ourselves with what's happening in the CBDC space and take it more seriously. Finally, gentlemen, what is your choice for the biggest or most important story of the past week, and why? Paul, can I ask you to go first, please?
Yeah, Push. Until this morning, it probably would have been something else, something on our list of articles that we talked about. But what transpired over the weekend was quite cool to read about. I guess in a sense, it'll be interesting to get a little more information on this. But if you haven't heard or read out there, the CEO of OpenAI, creator of ChatGPT, was ousted by his board. And investors and executives tried to save him, but the board decided to replace him with the former CEO of Twitch. And guess who snapped him up? Microsoft. Microsoft grabbed him and one other founder, and they've already gotten some other people that they brought on board. So Microsoft was up pretty strong this morning when I looked early on. I imagine they're probably continuing to hold that level up. I think for Microsoft, this is a big deal. And, you think about OpenAI, and they were looking at a valuation that was, nearing 90 billion. What's going to happen with that? That's going to be really interesting because you lost a key person. I haven't heard exactly the rationale behind what the board was doing, but clearly it feels like there's some level of, I don't know if mutiny is the right word or not, but something happened. And this is really interesting. And I think it's huge for Microsoft. They just snapped up something that probably was completely unexpected for them. And it happened within a couple of days. I think it's a big deal.
Absolutely. Yeah. It's such an exciting emerging space, the Gen AI area and everything that could bring to Treasury, and all kind of triggered by OpenAI's ChatGPT. It's something to watch and see if, the more established tech companies like Microsoft can take advantage of maybe some inopportune decision making along the way as a smaller company tries to make it big. I think for me, there was a cautionary tale to remind corporates and everyone really around tax transparency. Today, the BBC reported that Colombian pop star Shakira has reached a deal with Spanish prosecutors to settle a tax fraud case just as it was about to go to trial. The BBC says that the singer paid 7.5 million euros in a fine. Prosecutors had wanted to jail her for 8 years and fine her 23.8 million if found guilty. And that was all to do with a dispute over residency and what her status was between 2012 and 2014. Was she resident in Spain or elsewhere? And the tax implications of that. And we know from things like BEPS and other stuff in the tax world that touches on corporates and corporate treasury, that tax transparency is a hot topic for regulators globally. So clearly Shakira and this particular case is a very important one for treasurers to have a look at, and maybe queue up the playlist on Spotify as well while thinking about it.
Well, that's a great point in terms of tax compliance, and corporates are also advised to pay attention, corporate treasury departments to pay attention to FBAR analysis, foreign bank account reporting, as well as beneficial ownership information. Paul and Ben, your perspectives have enriched today's podcast conversation. Thank you ever so much for elevating the quality of today's discussion. We would also like to express our deep gratitude to our CTMfile audience for joining us on this edition of the Open Treasury podcast. Please subscribe and look in the show notes for the article links. Thank you and have a wonderful and pleasant, happy Thanksgiving. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.